Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so today we're going to talk about inflation.
Yes.
The numbers for May just came out. And specifically what we're going to talk about is how inflation is affecting real estate right now. Mm-hmm. So what we're going to do is we're going to show you a couple of charts. We're going to have inflation, the numbers for today. We're going to show you the historical, and then we're going to talk about how historically real estate prices have gone up and down and rents have gone up and down with inflation and how that's happening right now.
Perfect.
Okay.
Let's get going. Oh, by the way, if you like our videos, please hit the notification bell, hit the like button, share the video, subscribe. Okay, let's get back to the video.
Okay, so the first chart I'm going to put up here is the inflation numbers. Now, these numbers came from the New York Times. The data they got was from the Bureau of Labor Statistics. And it's basically year over year change to the CPI. So this is a percent. So this is a percentage change year over year. So what this means is if you paid, and it's an aggregate amount. So if you paid X for a whole bunch of goods and services last year, it's now 1.086%. It's a percentage more. So it's 8.6% more. You can see that this is not historically the highest inflation we've ever had. If you go back to the late 70s and early 80s, we had inflation that was over 14%, mm-hmm. right? Okay, so let's start with when you see the chart here. We're gonna come back to this chart because there's something I want to point out here. But this is a lot of inflation. We haven't seen this inflation in over 40 years. Mm-hmm. The year over year, it's 8.6. It's 6.0 though, excluding food and energy, mm-hmm. because they're volatile.
Yes.
They change rapidly because food supply can get disrupted easily and energy can be disrupted usually because of OPEC and things like that.
Right. So if you've been to the gas station in the morning and you go in again in the afternoon, you'll notice the gas price may have changed. Hence, we're saying that energy prices are very volatile. Okay.
So we're gonna get back to that chart because we're gonna talk about something specifically. So the next chart here is very important. But these are the specific breakdowns of the monthly change of prices in May. Now, this is the month over month. Now, the last chart you saw was the annual change. That's the rate of change year over year. This is the monthly change only in a month from April to May, mm-hmm. okay? Now, you notice the top things there: fuel oil, airline fares, piped utility, gas service, gasoline. Most of those are energy costs.
Right. So, we all know that energy is costing us more. And yes, we're aware that airfares are more than energy. They're also supply and demand and that sort of thing. But primarily, we're focusing on energy because all of these have energy as a common component.
Okay. What is one of the things right now that's disrupting? There's a couple things happening, but what's one of the main things causing energy to be high?
All the excitement going on with Russia and Ukraine.
Okay.
That's a lot of it.
Okay. So we're not buying Russian oil anymore?
It's not just that we're not buying Russian oil, but then other countries are not buying Russian oil, which is putting pressure on oil prices globally because now there is less supply, right? As people know, lots of people have referred to Russia as something akin to a gas station connected to a country.
Yep.
So that Russia is a big supplier of oil. The other thing is the U.S. energy policy has changed, right? We were doing fracking and all of this. The Keystone Pipeline was in the process. Alaska was in the process of pumping out more oil and that sort of thing. All of those things have now been disrupted by current energy policy, by the current administration in Washington. So all of these things have kind of come together to form this perfect storm of really high gas prices. We've all seen the memes out there that, that the car is X amount of dollars, but if it's got a full tank of gas, it's twice as expensive. Yeah. Because energy costs have definitely gone up.
The other thing you'll notice in here is that food prices have gone up quite mm-hmm. a bit. You'll see cereals, meats, poultry, fish, and eggs and stuff, and you go, oh, it's only up 1.5 or 1.3%. But the problem is this affects everybody because we all eat food.
Well, it does, and it affects us in a lot of different ways. So think about it this way. Not only are these grains more expensive for us as far as us consuming them. But remember, animals also consume grains because we have grains in feed. And so now animal products are going to be more expensive too. Remember that the Ukraine is a large producer of grains for Europe. And remember that Russia is the world's primary producer of fertilizer, which we need to produce grains.
And Russia produces the most grain for like Africa. Like they get all their Africa from Russia, like almost all their all the grain goes to Africa is from Russia.
Right.
Okay. All right. Now, what we're going to do is we go down this list. You see that everything is going up at some rate, but I want to talk about two things down here, which are rent and the owner's equivalent expenses or the owner's value of their home. So we have, they both going up at 0.6%. Now, the average person would say, well, 0.6%, that's not that much. But this, to talk about this one, this is actually month over month.
Right, so this is month over month. But, I want you to kind of think about it and put it in perspective. The gas prices going up, the cereal prices going up, the grain prices going up, those are much bigger numbers. They're much more impressive. But when you're looking at, well, how much do I pay for cereal? I'm paying, so much more for cereal. But it's not off of such a big number, right? But when you're talking about your rent payment going up by 0.6% or your mortgage payment going up by 0.6%, it's off a much larger number. So when we're looking at it and we extrapolate this over the course of a year, now that 0.6% increase in rent or mortgage is about the rate of inflation that came out yesterday, and it's 8.4%.
Yeah, so here's the thing. If you're 0.6%, so say you have a $2,000 a month mortgage, or not mortgage, rent payment, and it goes up 0.6 per month. You're like, oh, that's not that much. Yeah, that's over 7% per year. So what that means is 7% of $2,000 is $140. What that means is the next year, your $2,000 payment, if the landlord raises it, is going to go up to $2,140. And you're like, oh wow, that's like a significant increase in rent. So rents are going up, and home prices are following, because as rents go up, home prices follow because the cost of owning a home is not only based on comparable properties, but also based on this thing called income approach, which is how we value a rental property. Really is based on what kind of rents it's produced. They do this with commercial, but they tend to not do this with residential real estate, but it has been following rent. So as rents go up, home prices go up too. Because remember, if rent prices shoot up, home prices are going to follow, because home prices aren't going to stay low, because more people would want to buy a house if they can get a better ROI out of it, right?
Right.
Okay, now, here's the important thing. So what we're going to do is we're going to talk about two things. We're going to talk about why the inflation is actually something that's helping the housing market. Because everyone's, the housing market's going to crash. Well, there's two things that's happening. And first we're going to go back to the chart. So I'm going to go back to the first chart we showed. Now, there were two times in history, there were really three times in history where home prices went up substantially. One time was in the late 70s and early 80s. Home prices went up substantially, and they didn't crash. They kept going up. The next time they kept going up substantially is right now. And then there was also this other time, which was the last housing crash, but that wasn't an inflationary crash. That was a speculation crash, which is those things don't exhibit today. When you look at the inflation graph, what do you notice about late 70s and early 80s and now with regards to inflation?
Inflation went up quickly, and it went up a lot. But the thing that we notice about homes is that they continue to appreciate.
They continued to appreciate. So the inflationary rise of a home price didn't cause it to crash. What caused it to crash was speculation and bad loans. Now let's talk about this. The last time we had the housing crash, we were seeing 4%, 5% inflation maybe, But remember, home loans were higher. Inflation was outperforming your mortgage. Even with 8% inflation, people are complaining about 5% mortgages. But look, a 5% mortgage still beats inflation. So you put 20% down on a house, you get a 5% loan for the rest. Your home price is appreciating faster than your mortgage percent rate.
Right. And the thing to keep in mind is that so long as inflation stays high, mortgage rates will rise, because if you're a lender and you're loaning money out at 5%, 6%, and inflation is 8% or more, you're actually losing money on the deal. So unless inflation comes under control, the mortgage rates will keep rising, which means that homes will still be more affordable at 5 or 6% than they will be down the road, so long as inflation still keeps climbing.
Yeah, and we've seen this in the past where, we've been sort of spoiled. Like historically, we're still well below the 30, 40-year average of...
it was 7 and change.
It was 7 and change. It was 7.6% is the median. We've been below that for quite a while now, but people just got used to 2.5%, 3% interest rates and think, oh well, won't home prices go down? But remember, all of these things act at the same time. So you can't just look at home prices going up, which is what 90% of people do. They go, home prices go up, they're going to crash. Well, then then inflation is going to crash, and then gas prices all these things are going to crash. They're not going to crash. They're going to go back to some normal amount. What has never happened after a high inflationary period is home prices going down.
Right.
That's never happened, and it hasn't happened because the base inflation rate is what's it's driving prices, and then prices drive inflation. So this is a measurement of the value of things, is this inflation. So when you look at this chart, when you look at inflation and what's happening with home prices, this actually makes sense. Like if I just showed you inflation and told you back in the beginning of 2020 what would happen to home prices, every economist would say home prices are going to rise. They're going to rise substantially. Okay, there's another thing that's been happening. The stock market's been not doing very well. Okay, so this is a perfect storm. You have this war going on, which is affecting energy and food. You have inflation going on because of government spending, and you have the stock market tanking because of really high earnings per share numbers that didn't make sense. Like the people's valuation of these stocks based on the multiples were not in line with what a company's earnings are.
Right. So remember, part of the reason was because people were putting their money in the stock market, one, because they were following everybody else, and two, because they really didn't consider any other vehicle for their money. They didn't want their money to just sit there idle. But as real estate started to really take off, again, people follow everybody else, and people started taking their money out of the stock market and putting it into real estate, which of course caused the stock market to go down because people are sucking money out, and cause real estate to shoot up because money is being pumped in. So there are all these things going on, but part of it is just people following everybody else.
Okay, so the natural thing you're going to say is, okay, I get it. So what you're saying is people took money, they pulled it out of the stock market, they had a bunch of cash, they went and bought real estate because real estate is a great hedge against inflation, right? We did a video on this. We actually have done 2 or 3 videos over the last decade about this. People go into real estate. So the argument is, so when the stock market becomes a better buy, they're going to stump all these properties and sell them, and they're going to go and take that money and throw it back in the stock market because they can get a better ROI. The answer is negative. They're not going to do that. And the reason they're not going to do that is there was a cost to buy a house, there was the transaction costs, and there's transaction costs to sell, and there's time. And people don't want to, when people decide to invest, they don't want to wait 2 or 3 months for a house to sit on the market, close, and get the equity out. So what they do is they borrow against it. If they paid cash for the house, they go get a home equity line. We've seen this before, where investors buy a house cash, then they pull out 70% of the value in a home equity line and do something with it. So we will potentially see that, but we're not going to see the houses flood back onto the market because the stock market's a better investment. And the reason is because it's still a good investment to own the real estate because the real estate's still appreciating in value. So it's almost like the things you think would cause the market or the housing market to decline or collapse or whatever, or like actually are the things helping it stay afloat. They're like actually helping the housing market. And the other thing too is that it's highly likely prices will rise. We're not saying they'll rise. They could certainly go down. They could certainly stay the same. Most economists are predicting they will either rise or plateau or flatten out. Or virtually nobody's saying they will decline, and nobody reasonable is saying that they'll crash. There's a couple of people saying that that they could crash, but it doesn't make sense that that would happen. There's really nothing to support it because the cost to acquire, most people, and we have people that comment on the blog because we did this video that have said, well, I pay $1,200 a month rent or mortgage, and why would I sell my house and pay $2,000?
Right.
Like that makes no sense. And one guy even said, I don't care if my house is upside down. I'm never going to sell it because my 30-year mortgage is so cheap. I could pay this forever. This is not a problem making this mortgage payment.
Right. And look, even if you have to relocate, why would you sell a property that your mortgage payment is $1,200 if you can get $2,000 or more in rent for it, and you can put the difference in your pocket and you can go off merrily to your new location and start all over again. It really doesn't make sense for people to sell properties that they absolutely don't have to sell. We're in a different environment than we've been in the past. This is a kind of a new paradigm for everybody to consider, and I think you're going to see a lot of people that maybe never considered being landlords before considering it now when they want to either buy their move-up house or relocate, whatever is going on in their lives. I think that they will consider being landlords at least for a time because it makes economic sense. And I'm not saying that being a landlord is for everybody, but I'm saying that it's something for people who maybe had not considered that before to consider right now.
The biggest problem with being a landlord is people get emotional about it because they lived in the house, or they're not wired to handle the stress of a tenant and the stuff, which is why you hire a property manager to manage the property for you. You do pay some fees to them on a on a $2,000 a month rental. You're probably going to pay somewhere between $100 and $200 a month for every month that rent is collected. I thought it was very interesting that somebody put a comment on one of the videos that pretty much said that real estate agents, the reason they like our videos is because real estate agents, most agents are out there saying the market's going to crash. Come to me and sell your properties while you can, because they just trying to get a bunch of listings, and that we're not advocating for that. Which we're not advocating for that. Every time somebody calls and says they want to sell, the first thing we say is, do you need to sell, or could you rent it? Like, do you have to sell? Like, what's your reason for selling? Like, yeah. And some people say, look, I'm moving it. I'm taking the equity. I'm never coming back. I'm selling the house, and that's fine. And we go, okay, that's fine. But, we always like to know, hey, your house could get this for rent if you want to keep it. We'll help you find a property manager, kind of a thing. But, this thing with inflation, we're going to look at it every month. Every single month that the report comes out, we're going to track it. We're going to look at the two things, what the overall inflation is and what the housing inflation is. Like Juana pointed out, housing inflation almost matches the general inflation.
Right.
So housing is basically right in the midst of it. Obviously, energy and everything is causing it to be 8+%, because it's 6 if you take out energy and food. It's not 8.4, it's 6%. And then housing's actually more. Housing's inflating at a little over between 7 and 8%, which is normal. Housing appreciates faster than inflation. Normally we have home prices appreciate like 2% more than inflation, which is how we get that 4.7% is that median amount of appreciation for homes, right?
Right.
So just keep this in mind. The inflation is not going to cause a housing crash. It's actually preventing the housing crash. What would be bad for housing is if we had deflation.
Right.
That would be very bad for housing.
Right. Deflation is bad for everybody, which I know in some ways you go, oh, well, but things are going to be less expensive, and that's a good thing. But deflation is this thing that kind of tends to spiral out of control, much like inflation does too. And then for housing, that's a bad thing because a lot of people use their home as part of their savings plan, right? They hope that the home appreciates over time, and at some point it's paid off, and then at some point they can sell that house and use some of the money to retire or do something else with it, and the balance to buy their next home. So deflation is a dangerous thing, particularly for people who are looking at retirement in the not too distant future.
So anyway, the final thing I'm going to say about this is that mortgage rates will likely not go back down until inflation starts to go back down and the Fed starts to take action if it causes the economy to slow. That we're in this kind of interesting place where we don't want to have high inflation and then stagnant, like no growth. So we're not growing. We're in a recession and we have inflation. I think they call that it's stagflation. Mm-hmm. The economy's stagnating because the problem is you can't lower interest rates to stimulate the economy because you have inflation. Mm-hmm. It's kind of that tool that they have doesn't really work. The problem is with high inflation, you get to a period where people don't, they can't, it's harder for them to borrow money because if money's more, it costs more. Mm-hmm. They want to wait. Then they put off investments and things, and they don't grow their companies, and then bad things happen. But the bottom line is that real estate's going to keep appreciating as long as we have relatively high inflation. Mm-hmm. So, and the chart showed it was pretty straightforward that it's moving in line with inflation, and obviously it's outperformed inflation really the last couple years, but there's not a significant. Now, the other thing too is this, it's going to be market specific. There are some overbought markets. There's a couple overbought markets that are potentially, high, but remember that's based on, that doesn't include people moving there. That's kind of the thing that they've missed. They've said, you've got these markets that are high. Yeah, but there's a ton of people moving there. This is not just speculation in market. These are new entrants to the market, and there's the current housing supply can't accommodate them, so it pushes prices up.
Right. Look, the music for this musical chairs is not going to stop. People will keep moving around. The question is, will they keep moving to these markets that are quote unquote overbought? And so long as people are still flooding in there, there's a lot of support for those prices and for continued price increase because it's supply and demand.
One thing, if you noticed on the chart, was literally everything they measured appreciated, mm-hmm. including home prices. So it's not likely for the home prices to go down and everything else to keep going up. So absent some kind of black swan event, some unforecasted or unknown thing, there's not a lot of support statistically to show home prices are going to tank. We're not saying rush out and buy a house or anything like that. All we're saying is we're looking at the data, we're seeing what it says, and we're just telling you, our take on it, and that's it.
Right. And remember, owning homes or owning whatever it is that you own is a very personal thing. So look at your particular situation, see what makes sense. This is not financial advice. This is just life advice in general. Do something that makes sense for you, but do it wisely and do it informed. If you like the video, please subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.